Hello, thank you so much for watching us on Morning Markets. Not officially the end of summer, but it certainly feels like this is the last week of summer before kids go back to school. And as for the markets, we've got a lot that we're unpacking. Beijing's attempt to bolster the market is falling flat. We'll speak to a China watcher coming up in the 11 hour. Plus, we're in a lull of Canadian bank earnings. Last week, we had Royal and TD failing to impress. This week, we're going to have Bank of Montreal and Bank of Nova Scotia out tomorrow. Later in the week, CIBC. You are seeing a little bit of a bid in these stocks ahead of earnings. And late Friday afternoon, Instacart said it's going to go public, the first venture-backed tech IPO since December 2021. We'll talk about what the financials show and what it could mean for the broader market. But first, let's turn our attention back to those Canadian bank stocks. They have underperformed the broad market. TD has been one of the biggest drags after earnings. It closed at nearly a 2-month low, but it's one of the top weightings in our next guest's portfolio. Let's bring in Tim Regan. He's managing director and portfolio manager at Kingwest and Company. Thanks so much for being with us.
Thank you for having me.
So we know that Canadians, they might love to hate the banks, but they certainly love to have it in their portfolio. And right now they're screening pretty attractive on dividend yield and valuation.
They're very, very attractive. I mean, one looks at TD. We have a dividend yield of about 4.5%. We have forward earnings of under 10%. And people forget that TD, because their deal didn't go through in the States, they have all this cash to buy back stock as well. Now, they're going to be in the penalty box for about a year or so because of some AML issues in the States.
Anti-money laundering.
Yes, thank you. But, you know, that'll pass. It has passed before. And we think that really the market's reaction was a little overdone to TD.
So if it's going to be in the penalty box for over a year, does that mean you're prepared to be sort of a longer term wait and hold on this one?
Absolutely. When I say in the penalty box, I mean more somewhat with investors, but as well if they want to do U.S. acquisitions, it'll be a year or so. But it's a great company, and we're always prepared to hold, you know, for at least 2 or 3 years because we just don't know what's going to happen in the short term.
Everybody who used to come on and talk about why they like TD was for the U.S. exposure, but now the U.S. exposure is becoming a bit of a headwind, as it is across the board in the United States. Are you willing to be patient with that as well?
Absolutely, because a lot of it's cyclical. And the one thing people don't realize is that just in TD's Canadian wealth management and banking business, and it's posted in their quarterlies. Now, some of it's their allocation on the balance sheet, but they earn over a 40% return on equity in their Canadian business. Pretty good business to have that you can do that quarter after quarter. So Canada's great. We just think it's always traded very cheaply compared to what any other type of company would.
This is not just a TD problem, but seems to be a problem across the banks, and that's expenses, reining them in. And it seems harder than it has in the past for these banks to bring expense control into control.
Well, you are seeing some layoffs going on. You're also seeing some banks. There's a whole systems issue that a lot of banks have to put a lot of money into. One small bank that we own is called EQB, Equitable Bank. They're digitized, so their expenses are, that's their whole game, control our expenses. They do very, very well.
EQB has been the standout performer, even as we've been concerned about a slowdown in the housing market. How are you thinking about housing as it relates to the banks and then as it relates to more alternative player like EQB?
Well, Housing is very tough right now because we don't know the direction of rates, if they'll continue to go up. If rates can actually stabilize or perhaps go down a little bit in the next few years, it's the renewal of the 5-year mortgages that everybody's concerned about and what happens to the end homeowner consumer. And so I think, you know, the Bank of Canada realizes, I think they realize anyway, that, you know, pushing it too far, too fast is just going to kill the housing market and it's going to kill the Canadian consumer. So any hopes of a soft landing, if they keep pushing it, that's not going to happen at all. But if they do, you know, hold rates where they are and things kind of progress down a little bit, I think we may actually see some sort of soft landing for the housing market.
The underperformance in TD and across the banks, it's not really just about the banks. Broadly, it seems like the love affair for dividend payers has sort of fallen out of bed. Dividend-paying stocks have underperformed. Non-dividend payers have outperformed because, why? I don't know. You can now get a nice risk-free rate in the bond market. How are you thinking about whether you still love your dividend payers? Well,
with the dividend payers, people forget that, most of the money is institutional. So if I can get a bond that's 5% and a dividend payer that's 5%, it's equal. If I'm, the average person on the street and it's not an RSP, that dividend payout's worth a lot more after tax. It's fantastic. Unfortunately, they're a smaller group that's buying the dividend payers. But the thing about the dividend payers as well, people don't realize, I can get a 10-year bond, bank bond, say at 5% or 4, whatever it is, and I can get a dividend at about the same rate. Banks tend to increase their dividend by 8 to 10% per year. So you have a growing income stream that's inflation adjusted. People don't realize that bonds are not inflation adjusted and interest is heavily taxed. And
you don't get maybe the capital appreciation that you could get.
I'm not even getting into that because that's the biggest thing. And if the banks are paying out 45% of their earnings, they're reinvesting the other earnings, and if they can reinvest it at that 20% return on equity that they get, that should grow the business over time.
How active are you kind of buying these days? And let's call it the month of August. It's a low volume month, but it's been one that's weaker for the equity market. September, typically, seasonally speaking, is no stronger. Are you chasing after these value names because you're looking sort of a year or two out?
We have been making some changes, but the changes were made earlier in the summer. We now have TD. Well, TD's always been with us, but Royal Bank and Equitable, we now no longer have CIB and Scotia. That was earlier in the summer. We've been picking up.
Why is that? Why'd you get rid of them?
We just thought we'd go to a little more quality, and we thought that some of the idiosyncratic issues of individual banks, even though they tend to move in a pack, we'd rather weight ourselves towards a Royal than towards the other two banks.
So CIBC would be what? Exposure to the Canadian market, and Scotia would be kind of a turnaround story, which you don't know what the turnaround is.
Exactly. You should be on our analytical team because that's what they were telling. Yes, absolutely. Absolutely.
And so this could be like an insightful quarter for you as you watch what they have in hold and what new CEO Scott Thompson has to say about what the turnaround looks like at Scotia.
Yeah, it could be. But, we'll be believers when we see it start taking place. So never say never. But as an aggregate, you can't own all the banks. Or maybe you can, but we don't want to own all of them. But I still think that the banks that we may have sold off and switched into Royal Bank, they'll still do fine in the next 2 to 3 years.
A bit of a blast from the past, but on Friday we got a report on BlackBerry that Veritas, which is a private equity player in the U.S., not the Veritas here, was looking to maybe buy the whole company. No dollar figure was disclosed. It was all preliminary talks. But have you owned this one in a while?
We've never owned it. Now,
never.
People forget that it peaked at, I think, about $135, $140 back in 2008. So you're going back 15 years ago. Even at the end of 2020, it was $14, and today it's trading at, and I haven't looked at the morning market, $5 range. You know what? It's a different business. It's a patent licensing business with about $1 billion in revenue, and it's kind of a run-on business. And it's one of these things where, why get involved? Why spend energy chasing a name? And you just look at that pattern over time, and maybe it's better that BlackBerry gets taken off the market with private equity.
So much energy was spent on turning it around in the last decade, really meaningful, getting out of smartphones, pivoting towards cybersecurity and Internet of Things. And is it surprising to you that we didn't see more robust and consistent growth? Because those are two real markets that are growing.
You know what? The company was a wonderful company. Don't get me wrong. But technology changes so quickly. And the one thing that people gravitate towards is the fact that we have some of the big technology companies, Microsoft, Apple, Google, Meta, that have been able to maintain their superiority or the moat in their business. They're anomalies.
That's kind of the sad state of Canadian tech, right? And now we have Shopify, which is still growing. You can quibble about valuation. Do you have any Canadian favorite tech companies?
We really aren't in the tech space in Canada just because of the fact that we think that the valuation has got out there. Never say never. We look at them all the time, but the valuations never really come into our wheelhouse.
Instacart going public, is this something you'll be watching, if not buying?
No, we won't buy it, but we are watching it. I took a look at it, and back at the height in 2020, the private market valuation was $40 billion.
Yeah.
Last year, it ended at a $10 billion market valuation. I don't know what it's going to come out at, but one company we own is Sobeys, or Empire.
Yeah.
Empire, which has Voila, which is the Ocado system, which is really an Instacart for Sobeys. So we figure if you look through their financials, we're getting that for free. And it's a little Canadian Instacart on one grocery store. So, you know, Instacart is trying to be the Uber of ordering your groceries, and we'll see where that goes. But I think trying to figure that out is a mug's game.
All right, well,